Oil extending gains and hitting a 5-month high today. Worries growing over supply disruptions following a wide-ranging sanctions against Russian oil. For more, we are bringing in Patrick Haan, head of petroleum analysis at GasBuddy. Patrick, it's good to see you. So let's start right there, Patrick. Oil hitting this 5-month high. What explains that, Patrick? What's driving that?
Well, I think that the root here really goes back to mid-December when the EU slapped sanctions on so-called dark vessels that were sending Russian crude oil as well as Iranian crude oil. And now we've seen the Biden administration just in the last couple of weeks jumping in to offer new sanctions on some of those entities and vessels as well that are taking some of that so-called oil, or I should say some of those dark vessels taking oil to those countries as well. And that's really kind of started jumping in the markets. We've also seen colder than expected U.S. weather boosting optimism, as well as Chinese increase in demand as stimulus has been the talking point in China. So a lot of that, coupled with a lot of short covering, I think is what is boosting oil prices here in the interim. But keep in mind, while there has been this multi-week rally, at the end of the day, OPEC's spare capacity is still amounting to 5 million barrels of oil per day. So a short-term lift, especially with Trump reiterating the potential of tariffs on Canadian crude oil, but it may not last much longer.
And so, bottom line, Patrick, I'm looking at Brent, almost near 81 here, near the intermediate term. What are you seeing? Put a number on it for us, range.
Well, Brent cracking the $80 barrel mark, I really don't see it getting beyond the $85 or $90 barrel mark. Obviously, when Trump is inaugurated here in just about a week, there could be a little bit of volatility coupled with new bills that President Trump can sign. So we'll have to kind of navigate what is going to be signed first here in the first couple of days as his presidency and what that impact could look like. But I think ultimately, as we get close to spring, look for Brent to start settling back down, especially as we get closer to April and talks from OPEC start ramping up. Of course, OPEC had extended their production cuts through April. Whether or not they do that longer is really up in the air. And of course, President Trump's big promise to cut energy prices in half, the tariffs flying in the face of that. But ultimately, Trump is going to be very concerned about oil prices remaining elevated. So there could be action there in the weeks beyond his inauguration to potentially temper the mood of the market.
Yeah, and what does all this mean for gas prices, Patrick? Add it up for us, because they did fall slightly last week, right?
Yeah, certainly a little bit of an exception. Given the big jump in oil last week of nearly $4 a barrel, we saw a small drop of about a penny and a half in the national average. Now, it's not abnormal to see gasoline prices falling this time of year. As reported last week, the EIA showed a big 6 million barrel jump in gasoline inventories. Motorists post-holidays just don't have as many places to go. Keep in mind, some of those major winter storms dropping snow in areas that it's not accustomed. So some of the drop in demand also at the hands of some of this winter weather that's occurring. But in the weeks ahead, those tables could shift as maybe colder weather starts to move out. We do start to see refinery maintenance beginning in February and March, as well as the transition to summer gasoline. So while gasoline price is still relatively low, hovering just north of that $3 a gallon mark, I do think that higher oil prices and the seasonality that we expect to start in the next 4 to 6 weeks will likely turn the tide when it comes to gas prices.
You did mention earlier, Patrick, tariffs, Canada. Walk me through how you see that potentially playing out.
Well, certainly it could be a very troublesome sign for those, especially in the Midwest, where U.S. refineries are set up primarily to refine that Canadian crude oil. The epicenter of price increases, if those tariffs do take effect, could be the Great Lakes, where refineries are reliant on that Western Canadian select crude oil for inputs at their refineries. Slapping on the 25% tariff, theoretically, that could mean an oil price for Canadian blends that is closer to $80 a barrel, as you see on your screen there. And that certainly would not be very good news for refineries in the Great Lakes that predominantly take those 4 million barrels of oil Canada sends us every day. Canada also in a bit of a bind as the Trans Mountain Pipeline doesn't carry a whole lot, just a little bit under 1 million barrels a day, but it certainly could impact refiners in the Great Lakes, and that could mean higher gas prices temporarily for motorists in the Great Lakes.
Patrick, great to see you. Always appreciate your time and your insight.